Here are the headlines tonight. Get ready for a big jump in your EMIs. RBI hikes repo rate by 40 basis points, its first in 44 months. Cash reserve ratio also hiked by 50 basis points. Will suck out 87,000 crores from the system.
Monetary Policy Committee voted unanimously to increase the policy repo rate by 40 basis points to 4.40%.
RBI identifies food inflation as its biggest challenge, says global factors to keep prices high for the foreseeable future. Expects companies to hike prices as well.
Food price indices of the Food and Agriculture Organization, that is FAO, and the World Bank touched historical highs in March and remain elevated.
Policy blues on the Lal Street. Markets logged their worst day in over 8 weeks. Sensex dives over 1,300 points. Nifty breaks below 16,700. RBI's surprise rate hike wipes off 6 lakh crore rupees of investor wealth. Now all eyes on the US Federal Reserve, which is set to raise interest rates by 50 basis points. Will be the biggest increase in over 2 decades. US futures nudge higher ahead of Fed's big rate decision. India's biggest IPO gets strong demand on day one. Retail portion subscribed 63%. The portion of the issue preserved for policyholders oversubscribed within hours of the issue opening. A spike in food price inflation has forced the RBI, or the Reserve Bank of India, to hike interest rates, its first hike in 44 months. A 40 basis point hike in the repo rate, effective immediately, was announced earlier today by RBI Governor Shaktikanta Das. The central bank has also decided to suck out 87,000 crore rupees from the system by hiking the cash reserve ratio by 50 basis points. The moves will result in higher EMIs, but should also increase your returns on the time-tested fixed deposit.
Food prices to stay high. Cooking oil to stay on the boil. High fuel prices weigh on inflation. Slowdown in global demand. COVID lockdowns in China threaten world economy.
Based on this assessment of the macroeconomic situation and the outlook, the Monetary Policy Committee voted unanimously to increase the policy repo rate by 40 basis points, 40.
A massive 40 basis point hike, the first one since August 2018. The decision, taken unanimously by the central bank's high-powered Monetary Policy Committee at an extraordinary meeting on Monday and Wednesday. The hike ends a 44-month period of low interest rates and an accommodative stance by the RBI. But with inflation spiking and the consumer index rising to a 17-month high in March, the RBI was forced to go in for an out-of-turn interest rate hike even before its next scheduled review in June.
The MPC judged that the inflation outlook warrants an appropriate and timely response through resolute and calibrated steps to ensure that second-round effects of supply-side shocks on the economy are contained and long-term inflation expectations are kept firmly anchored.
Even the RBI concedes to what the entire nation knows. It is wildly spiraling food prices, which has sucker punched the Indian consumer. And if you expect any relief soon, don't. The central bank listed a litany of reasons why prices may not soften. From global crude oil prices, which have been stuck above the $100 level since February, to a shortage of wheat and other staples due to the Ukraine war. Cooking oil prices, RBI says, will remain high. There's even a spike in prices of fertilizers due to falling supply. Lockdowns, particularly in China, have disrupted the supply chain all over the world.
The risks of unprecedented input cost pressures translating into yet another round of price increases for processed food, non-food manufactured products and services are now more potent than before. This could strengthen corporate pricing power if margins get squeezed inordinately.
In addition to hiking the repo rate, the RBI has targeted inflation by sucking out 87,000 crore rupees in liquidity by hiking the cash reserve ratio, an amount banks need to keep as deposits as a proportion of the loans they give.
Keeping with the stance of withdrawal of accommodation and in line with the earlier announcement of gradual withdrawal of liquidity over a multi-year time frame, it has been decided to increase the cash reserve ratio, CRR, by 50 basis points, that is 50 basis points to 4.5% of net demand and time liabilities.
The RBI has allayed fears that the rate hikes will hit economic growth. Higher cost of loans normally discourages companies from borrowing and usually hurts the GDP growth rate.
It is reiterated that the RBI will ensure adequate liquidity in the system to meet the productive requirements of the economy in support of credit offtake and growth.
The central bank's midterm surprise is expected to be just the first hike in the coming months, despite it maintaining its accommodative stance. But with galloping inflation showing no signs of slowing down, the RBI could soon abandon all accommodation and turn into a hawk. Bureau Report, Business Today Television.
Joining me now, Madhan Sabnavis, our Chief Economist, Bank of Baroda. Madhan, great to have you with us, and you've been closely tracking the developments and the expectations of the RBI moving on the rate front. But this came as a big surprise, particularly to markets, out-of-turn rate hike that we saw today. What was your reaction? What do you feel are the key takeaways? How would you read between the lines here?
In fact, none of us really expected the RBI to take any action until June, because in April, during the policy, it was very clearly stated that the stance would remain accommodative, though there would be a gradual withdrawing of accommodation. So I think the way the RBI governors put it today is that the repo rate hike and the CRR hike are part of this entire process of withdrawal of accommodation. But what this really means is that the RBI has taken a more stern view on inflation. And all this while it was a case of saying that, look, inflation is high, but we can still wait because we do expect it to stabilize at some point of time. But today it looks like that the very fact that the MPC met 1 month after the earlier policy, the last policy in April, and unanimously voted for increasing the repo rate, it really means that they do think that inflation is going to be a major problem for us going ahead. And not just inflation because of food or fuel, I think it's very much broad-based. So I think that's what the RBI governor has pointed out. The manufacturers are passing on the higher raw material costs, fuel prices are already high, food prices are going up, and notwithstanding the fact that we're expecting a good monsoon, there could be an increase in MSPs coming, which would again further add to food prices. So I think generalized inflation is the major concern of the Reserve Bank of India today. And the feeling is that if we do not try and address this issue today, it could be affecting consumption going ahead, and which in turn will also affect investment and future prospects for growth.
So, Madhan, are you thinking that there are going to be further hikes given the scenario that you've just described? What would you expect or anticipate from the RBI in the coming few months?
Absolutely. I think there would definitely be another 50 basis points increase in the repo rate during this calendar year, which can go up to 75 basis points. So we could be ending at around 5 to 5.15% by March 2023. This is because as long as inflation remains elevated, and it looks like that it's going to be in this region of 7%, which is very, very uncomfortable for the MPC for some more time. So therefore, we could brace up for more increases in the repo rate, and hopefully it will be in a calibrated manner of 25 basis points each time. But given the surprise which we had of 40 basis points, I wouldn't really be surprised if we have another 50 basis points increase in June too.
All right. Now, talking about inflation, and what was really worrying in the governor's speech were the frequent warnings on food prices. There are clear indications that the situation could get much worse, as Madhan has also just alluded to. In fact, the RBI governor listed out various reasons. Let's listen in, and then we'll go back across to Madhan Sabnavis.
The sharp acceleration in headline CPI inflation in March 2022 to 7% was propelled in particular by food inflation by food inflation due to the impact of adverse spillovers from unprecedented high global food prices. 9 out of the 12 food subgroups registered an increase in inflation in the month of March. High-frequency price indicators for April indicate the persistence of food price pressures. Simultaneously, the direct impact of increases in domestic pump prices of petroleum products beginning the second fortnight of March is feeding into core inflation prints and is expected to have intensified in April. Looking ahead, food inflation pressures are likely to continue. Food price indices of the Food and Agriculture Organization, that is FAO, and the World Bank touched historical highs in March and remain elevated. Spillovers from global wheat shortages are impacting domestic prices, even though domestic supply remains comfortable. Prices of edible oils may firm up further due to export restrictions by key producing countries and the loss of sunflower oil output due to the war. Elevated feed costs are translating into escalation in poultry, milk, and dairy product prices.
All right, so that sets the context. Madhan, what is this going to mean for consumers? Everything is bound to get more expensive, of course, but also we're going to start to see some uptick on those fixed deposits. Overall, net, I mean, how worrying is this going to be for the end user?
Actually, it all depends upon whether we are a saver or whether we are a borrower. So I think for savers, it will be a big relief because a big increase of 40 basis points in the repo rate will automatically lead to increase in deposit rates. Maybe not commensurately, but probably to maybe 10 to 20 basis points uptake is something which one could see. But if you're a borrower, and I think that is something which has really picked up in the last couple of years, because as long as we had this easy money policy, we saw that the retail loans were the ones which actually propelled overall bank credit growth. And today, if you're looking in terms of home loans, they're going to get more expensive because your EMIs are going to go up. If you're an SME where you're borrowing funds from banks based on a benchmark, which is the repo rate, you automatically end up paying 40 basis points higher. So overall, I think the borrowing costs will go up. So as far as banks are concerned, given the fact that the deposit rates rise at a lower rate than the lending rates, it could be good times in terms of the NIMs for banks. But of course, for them, the counter would be that treasury income, which has helped their P&L accounts for the last couple of years, will no longer be robust. In fact, they may have to book certain losses. But in net terms, I think banks would be gainers on account of this. Borrowers will have to pay higher costs, and savers will probably benefit to a certain extent, though not to the same extent as the repo rate increase.
All right, so clearly a hit if you were planning to take out an EMI, and also, as Madhan mentioned earlier, investment plans may also take a backseat going forward. We'll have to see how this pans out. Madhan, how much of this was preempted because everyone's expecting that massive hike by the Fed coming in post this time's meeting?
Actually, the timing is such that it's been timed between two policies, and MPC met and took a decision just before the Federal Reserve took a decision. So I wouldn't like to read too much into it, but definitely there's a case of saying that we have seen that FPIs have been negative so far as far as India is concerned, and the fact that the Federal Reserve is almost definite to increase their rates by 50 basis points. I think that itself was an indication that probably something had to be done by the RBI. So I would say that while inflation has been the primary driver, somewhere in the background, the RBI is also concerned, the government is also concerned with the fact that we need to make sure that there is some alignment between what the RBI does and other central banks, because even the external account is something which one has to look at. So I think the way we should look at the overall rate change which has been invoked today is that from the stage of looking just at inflation to shifting over to growth during the pandemic time, we're back to looking at inflation with an additional responsibility of also seeing how monetary policy could affect the external account, that is the overall balance of payments. So I think that's how I would look at it.
Sure. Madhan, on growth though, and given that while the RBI may have had to consider some of these factors, and prioritize for the moment, when we talk about growth, What is the kind of impact that's likely if we're looking at 40 basis points now and another 50, as you said, coming soon?
Yeah, overall growth will definitely get affected at a margin. But I think that it was a case of balancing two things. That do I let inflation go run amok, which could be affecting overall consumption? As your consumption power comes down, you spend more money on necessities, discretionary consumption gets affected, which in turn affects investment. Or alternatively, you follow a policy of saying that, look, I'm going to increase interest rates. Definitely at a margin, as far as industry is concerned, investment is something which would slow down. Only those sectors which see a vibrant demand would go in for expansions, given the fact that RBI has also mentioned that there's been an improvement in capacity utilization. So therefore, we could be expecting investment to be positive, but it will not be broad-based. It will be across certain sectors which are not going to be affected by this entire process of the war, inflation, and rate hikes. But on the whole, yes, growth there's going to be some kind of a downside to growth. And our estimate is that there could be a downside of around 25 basis points. So we at Bank of Baroda had a forecast of around 7.4, 7.5% last month on GDP growth. So this could go down by around 25 basis points based on this 40 basis points plus another 50 basis points during the course of the year.
Madhan Sabnavis, thanks so much for joining us on the show today. Great to have you with us, taking a closer look at the RBI policy and its implications going forward. We're going to take a very quick break. Back with more on the other side.
Are lemons the new gold? Forget gold and silver, thieves are now stealing lemons. Yes, you heard that right. With the prices of lemons looking north consistently, these vegetable thieves stole 140 kg of lemons from a farmer's garden in Gujarat, Surat. The owner of the garden, Jayesh Bhai Patel, had planted about 1,500 lemon trees on his farm. Keeping in mind that the prices had increased, he had tightened the security of his gardens. But despite that, the thieves stole the lemons and fled. The cost of stolen lemons is estimated to be around 15,000 rupees. But it's not about lemons only. Anything with skyrocketing prices is a thief's delight. The Gujarat police arrested a gang of highway robbers involved in diesel theft. 6 persons were held for stealing fuel from vehicles parked near highway eateries. The gang is said to be involved in diesel theft from around 100 vehicles around Gujarat and even outside the state. With the prices of petrol and diesel going past the 100 rupee mark, even diesel theft is understandable. But do you know what is the latest to be stolen? It's precious water. Amid severe heat wave, people in North India are facing severe water shortage. In Gujarat's Banaskantha, a village head has been accused of stealing water. That too from water pipelines installed for other villages and cattle. The villagers allege that the woman Sarpanch, Hansa Ben Thakur, and 15 others were stealing water by making a hole into the drinking water pipelines. Since water was being supplied there through the government water supply pipeline, the people of Tirth Gaon of Vav Tehsil have lodged a case of water theft with the police station. All in all, thieves are humans too. With rising prices of essential commodities, the robbers are also stealing what seems important to them.
You are watching India Today.
Welcome back. You're with us here on Business Today. We're discussing the RBI surprise move to hike repo rates, and today it took the markets by storm. Markets, which were already on tenterhooks awaiting the US Federal Reserve meeting outcome, were stunned by the RBI's move and the quantum of the rate hike. 6 lakh crores of investors' wealth was lost as bears tightened their grip. Sensex shed over 1,300 points to end below 56,000. Nifty plunged almost 400 points to tumble below 17,000. All sectoral indices finished the day in the red, with Nifty media, realty, metals, banks and auto among some of the biggest losers in trade today. Broader markets mirroring the weakness, with the Nifty mid-cap and small-cap gauges falling more than 2% each. The mega LIC IPO was off to a flying start today. More than 60% of the IPO was subscribed on its first day. Policyholders who get a 60 rupee discount have been especially enthusiastic about the issue. The employee portion has also been oversubscribed. The retail portion has been subscribed 56%, while the non-institutional portion hit 25% subscription. In the QIB portion, bids have been received from 1/3 of the shares on offer. The numbers do not include those of anchor investors who've already invested 5,600 crore rupees in the issue before it opened for the public. Meanwhile, the grey market premium on LIC has slid to 65 rupees from 90 rupees 4 days ago. The 21,000 crore rupee issue closes on Monday, 9th of May. Earnings now, and Yes Bank posting a healthy set of numbers in Q4. The MD and CEO Prashant Kumar pushing for a review of the current process of resolving bankruptcies in the country, adding that banks cannot absorb the massive 80 to 85% haircut that they're being asked to take by bankruptcy courts.
If you see in terms of some of the haircuts which we are seeing, I think it is not good for the banking industry. Ultimately, it's a public money. Okay? So if some of the resolutions are happening at a haircut as high as 80-85%, then ultimately we are losing money for the public. So I think this is something which is not good, definitely. But I think this needs to be addressed. This needs to be addressed, and that can happen only if the process of the resolution happens at the earlier stage. And definitely also with the reforms in the whole legal system and how the entire IBC process works. So I think if that happens, and if the banks takes those assets for the resolution at an early stage, then I think recovery would be definitely better. But just to share with you, like I think within our bank, we are seeing a very good recovery. We have not seen that kind of haircut.
IDFC First Bank seeing a twofold jump of 168% in net profit in the quarter ended March on the back of strong core operating income and lower provisioning for bad loans. Listen in to what the MD and CEO of the bank, Mr. Vaidyanathan, had to say.
There is a very strong demand for credit at the mass people level. Basically, if you notice the country, the way we have run for the last maybe 70, 80 years, that credit from the banks was always available to the large corporates. And therefore, with credit, they grew. But people below the line were all operating on equity, I mean, the personal equity. So for the first time, they're beginning to get credit. So it's so credit starved there that the demand is actually coming from that side. So that's when you'll see most banks reporting on the retail side a growth of 20%, even large banks with the loan books of 4-5 lakh crores. They're all growing that at 20%. That's because there's so much of a strong demand there. The yield on that book on the retail side, because it's also credit starved and all that, is quite good. And the margins are very strong on the retail side. And more than margins being strong, the asset quality is very stable and very predictable.
Reduction in asset quality stress and steady rise in business leads to strong show by Mahindra Finance in the last quarter. Mahindra Financial Services reporting a stellar fourfold rise in net profit for the March quarter. Listen in to Ramesh Iyer of Mahindra Finance.
It's extremely important to understand the first quarter of the year was one of the most difficult quarter given the pressures of the second wave that the rural was going through. And our NPAs have raised to very high 16% levels. That's only second time in the 25-year history that we've seen that number. But we were very confident looking at the profile and the segment of customer we work with that they would bounce back. And true to that story, in the 3 quarters after that, We've seen quarter after quarter the improvement. The customers have come back to normal. The earnings have returned back to normal for them. The activity levels are kind of pre-COVID level already. And just to kind of talk a few segments, we talked about the tourism, we talked about the school operations, we talked about the temple tourism, we talked about people movement and the contracting segment. I think all these segments have opened up and people are actively engaged in their activities out there. The crops have been good, yields have been very good, the support prices have been good, and the farm cash flows have also held up. Rural typically works on these two cash flows, that is farm and infra cash flow, supported by the on-ground activity. I think all of this is what is added to a good return of normalcy for us from an overall corrections on asset quality is concerned.
Mahindra Holidays, meanwhile, back in the black with occupancies near pre-COVID levels. Despite the Omicron wave, the company has registered a profit of over 15 crores. Hear out CEO Kavinder Singh.
The best part of this quarter was that we hit our highest ever resort income at about 57 crores. And that is something that we did not expect, considering that in the month of January, we had Omicron. So despite Omicron, we delivered 77% occupancy, about 57 crores of revenues. And even at a year level, this turned out to be a great year for us in terms of resort revenues, our total revenues. So our income growth in the quarter was at about 19%. Our profits grew by about 37%. And we have also seen a margin expansion of 200 basis points. And most importantly, we added 385 rooms in this financial year, taking our resort count to 84 and our room inventory count to 4,568, crosses 4,500 mark. So this has been a great quarter as well as a great year if I were to look back. And also most importantly, in the month of March, we had the highest ever occupancy at about 89%.
While Biocon reported a drop in profits in the quarter, the company expects a significant jump in R&D spending in the next fiscal. We had a word with Biocon chairperson Kiran Mazumdar-Shaw. Listen into an excerpt.
The fact that we have got now 3 molecules which now are in a state of assuring future growth for the next wave, I think is very important for us. Adding to that is also, of course, our recombinant human insulins, where we have already filed 2 of the formulations and the 3rd is going to be filed a little later. But I think insulins is a very strong play for us. We expect to invest at an average about $100 million a year to expand capacities.
And that's where we leave it on the show today. Thanks so much for watching.